Confused by the terms like debit accrual or retained earnings? You're about to learn 50 must-know accounting terms simplified. Number 1 is assets. Assets are reallocable resources owned by a business. It could be cash, equipment, or property. Number 2 is liabilities. Liabilities are the debts or obligations that a business needs to pay off, like loans or bills. Number 3 is equity. Equity is those owners' stake in the business after subtracting liabilities from assets. Number 4 is revenue. Revenue is the income that a business earns from its core activities like selling goods or providing services. Number 5 is expenses. Expenses are the costs involved in generating revenue, like salaries, rent, and utilities. Number 6 is profit. Profit is the surplus amount that remains after subtracting expenses from revenue. Number 7 is loss. Loss is the situation when expenses exceed the revenue earned during a period. Number 8 is depreciation. Depreciation is the allocation of the cost of a tangible asset over its useful life. Number 9 is amortization. Amortization is similar to depreciation, but applies to intangible assets like patents or copyrights. Number 10 is balance sheet. Balance sheet is a snapshot of a company's financial position, showing assets, liabilities, and equity. Number 11 is general ledger. General ledger is a comprehensive record of all financial transactions made by the company. Number 12 is trial balance. Trial balance ensures that the total debits equal total credits to verify the accuracy of your accounting. Number 13 is journal entry. Journal entry is the process of recording financial transactions in the accounting system. Number 14 is debit. Debit is the increase in assets or expenses. Number 15 is credit. Credit is the increase in liabilities or equity. Number 16 is fixed assets. Fixed assets are the long-term assets, like buildings and machinery used in business operations. Number 17 is current assets. Current assets are the assets that can be converted into cash within a year, such as inventory or receivables. Number 18 is current liabilities. Current liabilities are the debts that need to be paid within the next 12 months. Number 19 is the long-term liabilities. These are the debts that are due beyond 1 year, like long-term loans. Number 20 is inventory. Inventory are goods or raw materials held by a business for sale or production. Number 21 is cost of goods sold. Cost of goods sold are the direct costs of producing goods that are sold by a company. Number 22 is gross profit. Gross profit is the amount of revenue left after subtracting COGS. Number 23 is net profit. Net profit is the profit that remains after subtracting all costs, including taxes and interest, from revenue. Number 24 is operating income. Operating income is the profit from core business operations, excluding other incomes and expenses. Number 25 is liquidity. Liquidity is a company's ability to meet its short-term obligations. Number 26 is working capital. Working capital is the difference between current assets and current liabilities, showing the short-term financial health of a business. Number 27 is break-even point. Break-even point is the point at which total revenue equals total costs, and the business neither makes a profit nor incurs a loss. Number 28 is variable costs. These are the costs that change depending on the level of production, such as materials and labor. Number 29 is the process of planning income and expenses. These are the costs that remain the same, regardless of the level of production, such as rent and salaries. Number 30 is overhead. These are the ongoing business expenses not directly tied to production, such as utilities and administrative costs. Number 31 is budgeting. Budgeting is the process of planning income and expenses for a future period. Number 32 is forecasting. Forecasting is predicting future financial outcomes based on past performance and trends. Number 33 is capital. These are the financial resources used to fund operations or investments. Number 34 is petty cash. Petty cash is a small amount of money kept on hand for everyday expenses like office supplies or postage. Number 35 is payroll. Payroll is the total compensation paid to employees for their work. Number 36 is taxable income. It is the portion of income that is subject to taxation after deductions. Number 37 is audit. Audit is the examination of financial records to ensure accuracy and compliance with regulations. Number 38 is cash accounting. It is a method where transactions are recorded when cash is actually exchanged. Number 39 is accounts receivable. It is money owed by customers for goods or services provided. Number 40 is accounts payable. It is money owed to suppliers for goods or services received. Number 41 is accrual accounting. Accrual accounting is a method where transactions are recorded when they occur, regardless of when the cash is received or paid. Number 42 is income statement. Income statement is a report of revenue, expenses, and profit or loss over a specific period of time. Number 43 is cash flow statement. Cash flow statement is a financial report that tracks cash inflows and outflows, highlighting liquidity. Number 44 is double entry accounting. Double entry accounting is a system where every financial transaction affects at least two accounts, maintaining balance in the accounting equation. Number 45 is capital expenditure. Capital expenditure is the amount spent on acquiring or upgrading physical assets like buildings and equipment. Number 46 is accounts reconciliation. Accounts reconciliation is the process of matching financial records from different systems or periods to ensure accuracy. Number 47 is return on investment. Return on investment is a measure of how profitable an investment is relative to its cost. Number 48 is prepaid expenses. Prepaid expenses are the payments made in advance for services or goods to be received in the future. Number 49 is deferred revenue. Deferred revenue is the income received before the service or product is delivered. Number 50 is generally accepted accounting principles. Generally accepted accounting principles is a set of rules and standards for financial reporting to ensure consistency and transparency.